Faster than anyone anticipated, the FCA issued a consultation on the 28th of April that includes significant changes to MiFID II research unbundling rules, with the FCA going further than the EU in proposing changes to address some of the unintended consequences. We are delighted that the FCA will present more detail on this consultation, giving the keynote address at our Unbundling Uncovered virtual event on June the 9th. It'll be the 7th year we've run this, and have been delighted at the FCA's involvement since our first event in 2015. In this latest consultation, the FCA is targeting issues with independent research and fixed income research, as well as SME coverage. Overall, the FCA is proposing 3 areas of change. Firstly, a fixed income research carve-out with inducement rules no longer applying. This means fund managers could be able to read anything within this asset class for free if the providers chose to allow that. Secondly, an independent research carve-out. Independent research would be exempt from inducement rules, which means that onerous controls around trialling these niche providers would no longer apply. And thirdly, a carve-out for research covering SMEs with a market cap up to £200 million. We don't see the SME carve-out as significant. The operational challenges for asset managers seem to outweigh the potential benefits. But the fixed income and independent research carve-outs should be beneficial for the buy side and the research industry in general. It was hard to understand how FIC research could be unbundled, and now these relatively smaller budgets can be redirected by asset managers to high focus areas such as ESG or alternative data. At the same time, it makes sense for independent research providers to be exempt from inducement rules, as they don't have a brokerage arm and cannot induce anyone to trade. IRPs were hit hard when MiFID II came into effect because brokers were prepared to subsidise their research departments in a way that independent providers couldn't. So suddenly, independent research became expensive by comparison. And we can see the results in the last budgeting cycle, as asset managers were more than 3 times more likely to cut an independent provider than a broker in their 2021 budgets, a trend that has accelerated since 2020. This proposed carve-out for independent firms, therefore, is timely. It won't change their inability to subsidise their product, but it will help large asset managers discover and trial independent providers without onerous compliance controls, hopefully now stimulating competition and greater diversity in research supply. Essentially, the FCA has moved ahead with modest changes that will be welcomed by the asset management industry. But whilst doing so, it has underlined its commitment to research unbundling. This seems to indicate that the European and UK regulators' propensity to rebundle research more comprehensively has been stress tested in the last 12 months, and these carve-outs could be as far as this retrenchment will ever get. Asset managers with operations in the UK will now have to address how to benefit from these changes and adapt their processes accordingly. They'll have questions on where to draw the line between FIC research and equity research, whether it matters who's reading it or if it's just about the research content, how to maintain a list of truly independent providers, and much more. Meanwhile, many global and continental European peers will be keen for the European regulators to follow suit, and it will be interesting to see how this plays out. We will be covering all these topics and questions on June the 9th in a series of keynotes and virtual buy and sell side panels. Please contact info@substantiveresearch.com or visit our website or social media channels to register. We look forward to a great day of analysis and debate, and see you then.